So the stock market just went on an absolute tear, shattering records day after day. But the real story here, the really weird part, is why. It's this whole bad news is actually great news thing. Sounds confusing, right? Well, let's break it all down. I mean, get this. For 3 days in a row, the S&P 500, which is a key benchmark for the whole market, closed at a new all-time high. A 3-day streak like that doesn't happen every day. It's a huge signal that there's some serious momentum building up. And hey, this wasn't just about the S&P 500. Nope, the tech-heavy Nasdaq, the iconic Dow Jones, they all jumped in on the action, hitting their own fresh records. We're talking a really broad, powerful rally here. It's basically the whole market screaming, "We're feeling confident." Okay, so that naturally leads to the big question, right? You hear all this chatter about an uncertain economy. So what on earth could possibly fuel such a massive, explosive run? Let's dig into the data and find out. So just how big was this rally? I mean, the numbers behind it are pretty staggering, and they really show the sheer force of what was happening last week. Okay, look at this. On Thursday alone, the Dow shot up over 1.3%. It absolutely smashed through the 46,000 level for the first time ever. That's a huge milestone. Meanwhile, the S&P 500 put up a solid 0.85% gain, and the Nasdaq was right there with it, up 0.72%. For a single day, especially when you're already at record highs, those are some really powerful moves. All right, so we've covered the what. Now let's finally get to the why. What was the trigger? Well, it really boiled down to two key pieces of economic data that landed this week and completely flipped the script on Wall Street. First up, we've got the CPI. You've probably heard of it. It's the Consumer Price Index. Basically, just think of it as our official scorecard for inflation. It tracks how much the prices are changing for all the stuff we buy, from gas to groceries. And believe me, investors were watching this report like a hawk. So, the number for August comes out, and it's 2.9%. Exactly what everyone was expecting. No surprises. Now, you might be thinking, okay, so what? It was just as expected. But for the market, that's beautiful news. For investors, boring is good. It means no nasty surprises with inflation, and it suggests things are under control. And then, to add to that good feeling, another report dropped, the Producer Price Index, or PPI. This one tracks wholesale prices. And it actually had a big surprise. It fell. Everyone thought it was going to go up, but it went down. So yeah, even more great news on the inflation front. But wait, here's the twist. The inflation news, it was good, for sure, but it wasn't the real headline grabber. The thing that really lit a fire under the market came from somewhere else entirely. And this is where things get a little weird, a little counterintuitive. 263,000. What's that? Well, that's how many people filed for unemployment benefits for the first time last week, and that number was a pretty big jump. It's a clear signal that the super hot job market might finally be starting to cool off a bit. And this is where we get to the core of that whole bad news is good news logic that's driving everything right now. See, a cooling labor market suggests the economy is slowing down. Now, normally that sounds bad, right? But for investors right now, it's music to their ears. Why? Because it gives the Federal Reserve, the U.S. central bank, the perfect reason to step in and cut interest rates to help juice the economy. So here's the bottom line. After that jobs data came out, the market went from thinking the Fed might cut rates to being almost certain of it. Look at this. Traders are now pricing in a 95% chance of a quarter-point rate cut at the next meeting on September 17th. And you've got to understand, lower interest rates are like rocket fuel for stock prices. Okay, so we've got the big picture, but how did all this play out for individual companies? A day like this always creates some pretty wild winners and some confusing losers. So let's take a look at a few of the biggest movers. We're going to zoom in on 4 companies that had just wild days. The software giant Oracle, media company Warner Bros., the real estate tech firm Opendoor, and of course, Delta Airlines. Each one tells a really interesting piece of the story. First up, Oracle. The stock just surged. This is all part of that massive, ongoing frenzy for anything and everything related to AI. Investors just see this incredible soaring demand for AI infrastructure, and it's just sending stocks for companies in that space to the moon. Then you've got stories that are all about specific company news. Take Warner Bros. It had its best day ever in its entire history, all based on reports that it might merge with Paramount. And get this, Opendoor. The stock skyrocketed. I mean, literally 79% in one day. And why? Because they named a new CEO. That's it. Incredible. Okay, but now for a real puzzle. Delta Airlines. They came out and raised their sales forecast. That's supposed to be great news, right? That should send us stock soaring. But what happened? The stock fell. So what gives? Well, the answer is a perfect little lesson in how the market really thinks. Investors just looked straight past the good news on sales and zoomed in on something else, rising costs. They're worried about things like tariffs. They figured those costs would squeeze future profits, so they sold the stock. It's just a perfect reminder that the headline you read isn't always the whole story. Okay, so let's pull it all together. We've got broken records, we've got rate cuts looking like a sure thing. What does this all mean for investors? What are the opportunities here? And maybe more importantly, what are the big risks to watch out for? All right, here's a simple breakdown. On the opportunity side of things, lower interest rates are usually great for growth in tech stocks. They also tend to make things like bonds look more attractive. But, and this is the big one, the huge risk that everyone's got their eye on is this pivot point. That's the moment when bad economic news stops being good for stocks and just becomes, well, bad news. You know, if you want to get a sense of the current mood in the market, a great place to look is the VIX index. It's basically known as the market's fear gauge. It's pretty simple. When the VIX is low, it means investors are feeling pretty calm and optimistic. They aren't expecting a lot of crazy swings. When it's high, it means fear is creeping in. And right now, the VIX is sitting at a very low 14.71. That tells you that, for now at least, calm and optimism are the name of the game. There's really not a lot of fear priced into this market. And that really brings us to the final critical question here. Right now, the market is throwing a party, celebrating weak economic data because it means rate cuts are probably coming. But you have to ask, how long can that last? At what point does bad news stop being good news? When does a slowing economy stop being a reason to buy stocks and start becoming a real threat to company profits? That's the big tension, right at the very heart of this incredible record-breaking rally.